Hello, this is Jeff Sokol back with the Smart Wealth series. This is video number 5. What we're looking at here today is avoiding risk in your retirement plan and avoiding risk in your life altogether, not just in retirement, okay? This is what I want people to understand. I know we're talking about retirement a lot of times, but this has to do with your entire life. I don't care if you're 25 years old or 65 years old. This portion, especially this portion, has to do with making sure that every part of your life stays safe and congruent with your goals. And what does that mean? Well, we're going to expose certain risks that you don't know even exist, and they have to do with your health. Okay, some of it has to do with your health, others have to do with finance. We've talked a lot about risk already. We've talked about risk in the market. We've talked about market loss. Okay, we've talked about some illness. We've talked about 401ks, their fees. Okay, we've talked about taxation. We've talked about inflation. But what we haven't talked about enough is risk in retirement that you don't quite know how that goes, and the risk that is there that most people don't know is that big of a risk to them. And this is a touchy subject. I got to tell you that people hate this subject. This subject, it's like it's the worst subject to go over with people because their eyes kind of glaze over and they think, well, nothing's going to happen to me. Oh yeah, it happened to my aunt. Oh yeah, it happened to my friend's mom. Yeah, but it's not going to happen to me, right? They always say that, and you probably said that before yourself. So what we're going to look at is what the risks are and how to avoid them. And this is a major risk, okay? And you might think, well, I'm healthy as a horse. What does this have to do with me? Well, look, we're going to go over a couple of things here, and then we're going to go over even in deeper detail how to invest like the wealthy, where you get market gains without the risk. Okay, so I know we've been over that already. We covered indexing in the last video. I want you to seriously get this. We're taking losses off the table. And I want you to fully understand how that works, what indexing is. We're gonna go over indexing, and I'm gonna show you doing it with numbers. Okay? We're gonna do it with numbers, and we're gonna do what I call an educational appointment. We're gonna do a mock educational appointment that I already have pre-recorded. I'm gonna show it to you, and I'm gonna show you exactly what it is that we do. I'm gonna let you look up the skirt, okay? And I'm gonna show you exactly what it is that we do to make sure you don't pay any taxes in retirement, and you don't pay any. That's if you don't want to. Okay, this makes it optional, and so we're gonna show you the inside, and that's all there is to it. We're gonna show you exactly how to do this and exactly what it is and exactly what you need to know so you can be well equipped. Okay, this is the big deal. All right, this is the big part of it. This is what we do. This is the educational appointment, okay? The educational appointment, what it does, it opens your eyes to the possibilities. Everything we talk about here is going to be wrapped up inside of this educational appointment. And you can see it again and again and again, review it again and again and again. Okay, so let's go ahead and jump into it. We're going to start off in the book. We're going to talk about truth in retirement, risks you never knew existed. So here we go. In the opinion of 99% of people, the largest risk to their retirement cash, wherever they hold it, is probably market risk. I think you'd probably agree with me that market risk is the number one risk as far as you think you may be concerned to your portfolio. But is it? Most people understand that they can't save themselves into prosperity, so we rely on investments and compound interest to do the long-term work. However, though that is the opinion pushed on us by the majority of banksters out there, they would be wrong. Market risk is not the number one risk to your retirement. The number one risk to your retirement is your health. Harvard Law completed a study on bankruptcies in the United States, and what was found was absolutely shocking. They discovered that over 60% of the bankruptcies that take place in the United States are due to medical incapacitation. Basically, they get sick and income stops. Then they dig into their retirement funds to pay bills. And that's the bottom line. They dig in there to pay bills. And eventually they go bankrupt. And we can't blame health insurance for that fact, okay? Because 78% of the people that went bankrupt had adequate health coverage. And the problem is the high cost of medical bills that aren't covered by insurance. It's the ancillary bills that come along with it, and the fact that income slows down or stops for most people after they have a heart attack, stroke, cancer, anything like that. Okay, any major critical illness or chronic illness that comes in that might put you into a state of some sort of disability where you can't do two of your 6 daily major functions, like cleaning yourself, bathing yourself, feeding yourself, clothing yourself, things of that nature. Okay, so according to the CDC, if you come down with an onset critical illness like a heart attack and cancer, stroke, kidney failure, etc., before the age of 65, you have a 70% chance of survival. People just aren't dying as much as they used to due to these issues. Now, also discovered, the average age of onset critical illness in the United States was age 43, and the average age of bankruptcy was age 44. Now, do you see the correlation there? People are getting sick at age 43 and they're going bankrupt at age 44. Today, the average death in America is 80 for a female and 74 for a male, and it's getting longer every single year. The lifespans are getting longer every year. So it's absolutely necessary to be prepared for these events as they do happen, and none of us, no matter our diet or workout habits, are immune to any of these things. Okay, we all know people that work out and eat right and everything else. They buy the organic health food store and all that stuff, and they still end up getting cancer. Okay, Lance Armstrong got cancer, for goodness sakes. Okay, I mean, you don't get a guy that's much more healthy than Lance Armstrong and he still had cancer. So we understand now that the risk itself of becoming ill is unavoidable at best. Of course, we can help to prevent this illness by getting the right minerals, maintaining good diets, getting plenty of exercise, reducing stress. But what can we actually do to mitigate the financial risk? Now, I want to cover here, I'm not a doctor, all right? Don't take any medical advice from me. Don't take any legal advice from me. Don't take any tax advice from me because I'm not in front of you. I don't see your books and I'm not your CPA, okay? And I'm even going to say, because I don't see your books in front of me right now, and you and I don't have an appointment set up, I'm not your financial advisor. I'm telling you what this is and how this works. Okay? So unless you and I have an appointment together and I make specific suggestions as per your specific situation, this is general information to you. Okay? This is general knowledge that may or may not fit you. Okay? And that's a disclaimer, of course. So, that being said, and of course we're off script right now, but that being said, we do have lots of things that we can teach you and show you also in regards to health and actual cancer cures that do work. Open your mind up. They do work. It is real. Cancer has been cured for many, many years, and we know what those cures are, okay? Anyway, let's get back on script. Decent health coverage, as we discussed earlier, will only get you so far. It will help you against medical bills piling up, forcing you into early bankruptcy. However, do we need an illness? How do we keep an illness from forcing bankruptcy when your income stops? Well, this is one answer. It's a simple answer. Living benefits life insurance. Okay? Living benefits life insurance. And we have covered living benefits life insurance here briefly. I'll keep this short and to the point. Back in the early 90s, Dr. Marius Bernard saw the financial ruin of many of his patients were experiencing after having survived serious heart issues. He was a heart doctor, okay? And he was saving people's lives. Many of them could no longer attend the strenuous work to which they had become accustomed to earn a living. Therefore, their income suffered, and as a result, their way of life had to change. Oftentimes, this resulted for them in bankruptcy. Dr. Bernard petitioned the UK to assist in creating products that would allow patients to access all or part of their death benefit on life insurance upon any type of critical illness, whether or not they deemed it to be terminal. This is a big deal. Today, most companies, if not all, will offer what they call an accelerated death benefit if the person becomes terminally ill. Therefore, if the doctor says, hey, Jim, you've got 6 months to live or less, then the insurance company will say, okay, well, you're as good as dead anyway. We have to pay this bill anyhow. Might as well just pay you out right now. That's how they look at it, okay? So if the doctor says that guy's going to die soon, and because he's got, stage 4 pancreatic cancer, then they say, okay, here's the check. Spend it as you see fit. And this isn't just with, look, this is not, the type of living benefits that we offer. Of course, we offer that. Okay, like I said, everybody offers that. But that is like if you're fixing to die, okay? What we offer is something grander than this, and it's a much bigger deal, and it's a much better deal, right? So, because guess what? You're not going to die most of the time these days. It's the bottom line. You're just not going to die. So you have a 70% chance of survival, as we previously mentioned, if you're under the age of 65. And most of you, I am sure, are under the age of 65 if you're hearing me right now. So, the accelerated death benefit, if a doctor says you have less than 6 months to 2 years to live, in most cases, your death benefit can be triggered while you're still alive. This is good news if you don't die. If you don't die, that's good news. Seeing this, large companies started offering people what we call viatical settlements. A viatical settlement, going off script here for a second, is when another company buys your life insurance policy. All right? So large companies start offering people viatical settlements for their insurance policies, healthy people, mind you. So they might find an elderly lady who's still relatively healthy, and she has a paid-up whole life policy, and meaning that that's self-sustaining and no additional monies are necessary to put into it, and offer her a large sum of money for that policy, more so than it's worth in cash value. So here's an example. Dottie Doolittle, that's not a real person, by the way. I don't think so, not my client, has a $200,000 face amount in her whole life policy with $50,000 in cash value. It makes enough money every year in interest, okay, and earn interest to pay the annual premium. So it's called paid up. A fictitious company called Rimfire Stashaway is a large multi-billion-dollar corporation that buys life insurance policies. Dottie is 75 years old and in okay health, but not great, and she wants to travel before she becomes unable to. Rimfire Stashaway offers Dottie $100,000 for her paid-up insurance policy. If she is chronically or critically ill and she needs the money, it is income tax-free for her. This also makes Rimfire the owner of the policy and the beneficiary. 3 years later, Dottie dies. Rimfire receives $200,000 for their $100,000 investment. Insurance companies hate this. Okay? They hate it. Why? It's simple. It costs too much. Okay? See, insurance companies had their numbers crunched perfectly for a very long time, for years. They know that only 50% of whole life policies ever pay off. Why? Because people cash them out. They need the money, they need the cash value, they'll take it out. And only 2% of term policies ever pay off. So most term policies out there, if you have a 2% payoff rate, that means 98% of the people that are giving you money never receive anything in return as far as term life is concerned. Now, they never pay off a beneficiary to serve their purpose. People, they just get, the policy lapses, or they live too long, or they just get sick of paying for it, they stop paying for it, whatever the case may be, it lapses. All right, so most people just throw money into a term policy that is not a living benefits policy. They just throw money into a term policy, and 98% of people never see anything for their dollar. Just peace of mind for a short period of time. In a whole life policy, the insurance company who got to use the money, so that $50,000 that's sitting in there, they get to use the money, giving you guaranteed growth at a certain rate. And for term life, they're just able to collect money 98% of the time without having to pay out a death benefit. This bodes well for the insurance companies. Now, like I said, Viatical Settlements made sure that 100% of the sold policies were collected on, making costs skyrocket considerably. Okay, costs for the insurance companies. So instead of 98% of the term policies not paying off for the consumer, the Viatical Settlement Company purchased those term policies for cheap, and every one that they purchased for cheap ends up paying off. Okay. Now, in 1996, when HIPAA was passed, viaticals and accelerated death benefits became non-taxable for critically ill or terminally ill insureds, thus allowing greater growth for this type of process. The insurance companies then did the only thing that they could, living benefits. They had to compete, right? They figured out that it was cheaper to offer an accelerated death benefit for a portion of the death benefit if someone was not terminal than it was, it's supposed to be then it was to pay out the death benefit. So if John Doe has a heart attack, but it looks like he's going to make it, they might offer him 75% to 90% of his death benefit, or a tax-free lump sum of $750,000 out of a $1 million death benefit. That's term or whole life or index life, okay? Or a universal life, I should say. So whether you're paying, no matter how old you are, no matter how much you paid into it, if you're paying for a term policy with living benefits that has $1 million face and you're only paying $50 a month because you're young and you're healthy, you could end up with a check for $750,000 if you ended up getting cancer and living. Okay? Now, is this a large insurance company doing this to take care of the American consumer out of the goodness of their hearts? No. They're doing this because they just saved 25%. Okay? So after you cash out your 75%, the contract is over. They're saying, hey, look, we just saw you get sick. Chances are you might get sick again in the future. We're going to give you $750,000 tax-free lump sum right now at the ripe old age of 43 to cancel this contract. You know, you can take it or leave it. They don't negotiate. They look at your medical records, they look at your medical history, and they see the problem, and then they say, okay, this is what it's worth to us to get you off the books. It's typically over 75%. Okay? Now, like I said, they just saved 25%. So you cash it out, it's over. John walks away, hopefully healthy, from now on to live out the rest of his life with an additional nest egg of $750,000 in cash to take care of his expenses as he sees fit. So he can pay off his home, he can pay off his vehicles, he can start a business, do all three, pay for his daughter's wedding, buy a boat, buy a yacht. Whatever he wants to do with that $750,000, it's his, and it's tax free because it's a death benefit, and so therefore he can have it, and he can do whatever he wants with it. Now, some insurance companies have deceived the public by marketing their riders as quote unquote living benefits when they are just terminal illness riders. Okay, I hope you understand the difference. Terminal illness riders are a completely different deal than just living benefits. Or living benefits are a completely different deal than just terminal illness, rather. I should say it that way. Others will actually monitor the spending of living benefits. Now, you don't want that either, because some will say, yes, we have living benefits, but that means that we'll give you $2,000 a month for this, for a specified amount of time, and we get to monitor how you spend those funds. They can only be used on home necessities and things of that nature. We don't want that either. We want a lump sum, tax-free lump sum, that we can do whatever we want with, okay? Because we can turn that into another investment if we want to, and that's real living benefits. We don't think that you need a babysitter, right? And so those types that tell you how much you can spend per month and what you can spend it on, that's paid out in like an annuity style where they pay you out so much per month for a certain amount of time. The insurance advisor must be knowledgeable about living benefits, and some of the largest companies in the world in the United States have bamboozled customers and have been sued for it. These companies have been sued for such things. And some of them, it's crazy to think these companies are so big and they still got so greedy and they've been sued. Really, really big insurance companies in the United States. So make sure your agent knows which companies are the best living benefits providers. If you need any help with that, you can always ask us. If you need to be sure, contact us to set an appointment with one of our qualified advisors in your state, and we will get you the policy that you need. Now, determining how much coverage you need. This is what makes me sick, and this is what keeps me going in the insurance and financial arena, is because I see people that are underinsured when people are just doing it for a paycheck. Okay, insurance agents are just trying to get a paycheck out of anybody that they can, and not giving someone enough coverage. I get disgusted when I see people having just enough life insurance to cover their home, thinking that they are taking care of their families. See, an insurance person should be an advisor. I don't have anything to sell you. Okay? That's not what this is. I'm a consultant. And if you want to take care of your family, I can show you how to do that. Other people, and that's what we do as agents with BeneShield, all right? And this is a BeneShield video, and so I'm not going to call it a shameless plug because this is what we do. And it's what keeps BeneShield a step ahead, and what keeps us rolling is that we can offer that kind of consultative educational information as opposed to just telling somebody, yeah, you're covered because you have $320,000 mortgage and your $350,000 term policy is enough. Okay? That's not how we do it. That's not taking care of the family. And it's not even and most insurance agents do not sell living benefits, sadly enough. Now, it's not the fault of my client when my client comes to me and says that this is what I have. It's the last agent that was just slinging policies, not caring about the client's long-term well-being. Here's a case I had a while back. Joe, named Change to Protect the Innocent, is one of the good guys. Hardworking American with a nice wife and 3 kids living in the beautiful state of Texas. Joe had a $350,000 term policy from a very large and well-known insurance company. He owed $320,000 on his home, and he was 45 years old at the time. Joe thought he was covered. After explaining to him that he was underinsured and he didn't have living benefits, which, of course, he'd never heard of, he was rightfully infuriated. Joe was not educated by his agent. And that's what we're talking about here, okay? Joe barely had enough life insurance to pay for his house and bury him if he died. If Joe got sick and he could no longer work the construction/mining industry to which he had grown up in for 25 years, he would no longer be able to cover his policy and would have to go into his 401k to pay bills. That's the bottom line. Joe was one sickness away with 3 kids and a mortgage and a wife from total and complete financial ruin. So here's how we figured out how much coverage Joe needs to meet the obligations for his family. So how much does it cost to pay off his home? $320,000. Kids' education, we call that $50,000 each. Some people might call that low, but we'll call it $50,000 each for his kids' education. We're talking about college education. It's $150,000. Nest egg for his wife. We said she needs at least $500,000 to be invested in an index universal life policy for retirement. So for a total of $970,000 for his family will be taken care of in the event of Joe's death. We take this number call it $1 million, okay, and add an additional 25% for safety. Now, why do we add that 25%? Remember what we talked about earlier, right? We talked earlier about that. You add up all your bills. What are you going to need? Okay, this is how we do it for living benefits. We add 25% because if you get sick, the insurance company gives out an average of 70 to 75%. So we add 25% for safety. So this is $1.25 million in coverage that will help ensure that if Joe gets a critical illness, his lump sum of living benefits will meet his needs. And if he did die suddenly, then his wife would simply be better off with a larger sum of money. Okay? We also looked at educating Joe. So we got Joe fully educated and his wife on indexing, taxation, 401ks, etc., just like you are right now. And we were able to construct for him a situation where he was paying less money out of pocket monthly for his retirement security with us than he was winging it with his other 401k and old style term insurance policy that did not provide him living benefits. Now, if Joe were to get sick with this $1.25 million, if he got sick, then he would get a very large lump sum check, over $900,000. So we're looking at the ability for him to be able to take care of all of his bills, all of his needs, everything that could be necessary for for the foreseeable future. And we're doing a better job for him, and he's not going to lose any money in his 401ks. He's not at risk there anymore. We removed all the risk out of his life and did it for less money just by streamlining what it is that he's doing. Okay? So the fact of the matter is that at the time of this writing, there are about 149 million life insurance policies in the United States. And less than 2% of those policies actually have true living benefits that allow you to spend the money as you want. Less than 2% actually know about this. You are now part of that 2%. You now understand something that 98% of America has no clue on. And I urge you to take advantage of it. So let's talk about Dr. John. Dr. John had an index policy with one of our team members. The plan was for his retirement that Dr. John was going to put away $2,000 a month into an index policy for his golden years. He was in decent health and in his early 50s, so this bought him around $900,000 in a death benefit. And with the growth benefits and indexing of our plans. Now, however, in less than a month, Dr. John wanted to cancel his policy, as was his right, within the first 30 days. His advisor questioned him. He said, "Doc, why do you want to cancel? What's the problem?" He said, "Why do you want to cancel so soon, Doc? I thought you loved the policy." Dr. John said, "I do love the policy. I love the fact when the market goes down, I can't lose money. I can still take advantage of market gains. I love the tax-free income at retirement. And I love the fact that I can even transfer that income to my wife after I've passed on if I so choose to do so." Then what happened, Doc? Now, this went back and forth. He's like, "Look, I just want my money," and all that stuff. But to make it short, Doc hesitantly told his advisor, he said, "Look, I don't know how I passed your physical to get this life insurance, but I took a physical at the hospital, as I do annually, and I have esophageal cancer, throat cancer. I'm going to need every dime I have, and I just need my money back. So please give me my money back." The advisor said, "Doc, I'm terribly sorry to hear that, but we're not going to ask for your money back. We're going to file a claim." He goes, "Are you brain dead, son? I said I have cancer. I didn't say I was dead. Don't start digging my grave just yet, lad." And the advisor said, "Doc, I'm sorry if you didn't understand what you bought, but you have something built in here called living benefits that pays you your death benefit without you having to die. Let me see if I can file a claim. If I can't, I promise I'll get you your money back." And within 6 weeks, Dr. John had a deposit in his account for roughly $735,000 in a lump sum tax-free payment to be spent as he saw fit. Dr. John had great health insurance, but still claimed his expenses outside of what health insurance covered exceeded $110,000. So he still had that extra expenses just to get over the cancer, outside of what his already good doctor health insurance had. This would bankrupt 99% of America. Luckily, Dr. John was well taken care of by a knowledgeable advisor, which allowed him to meet his needs and then some. This is living benefits. This is what we do. Today, Dr. John is still practicing medicine and is singing the praises of our associates. I'll tell you about Chris Edwards. We can use his name here, it's no secret. But Chris gave an emotional testimonial on living benefits and how it changed the time that he did have left here on earth. Chris was a great guy. Chris's friend was an agent for one of the major players in the living benefits side of the life insurance industry and helped get Chris the proper coverage that he needed. When Chris was diagnosed with cancer, he received a check for over $630,000 in cash. With this, he was able to purchase a home for himself and his wife on the lake, and he was fighting cancer the entire time, you understand. He was able to help his son to purchase his first home with a down payment and was able to walk his daughter down the aisle and give her the wedding of her dreams. When Chris passed away, as often happens to survivors of cancer after chemotherapy kills off the immune system, but that $630,000 ensured that Chris was able to stay out of bankruptcy while leaving a lasting and memorable impact on his family's long-term prosperity. Though he's moved on, Chris acknowledged that had it not been for the living benefits, his family would have been financially devastated and was extremely grateful for having had the living benefits. The cold truth here is that people own a living benefits policy for an average of 8 years before a critical illness claim is made. 8 years. That's a scary statistic, but it's a real statistic nonetheless. Living benefits life insurance policies are usually priced the same or lower than other old-style life insurance policies, so there's absolutely zero excuse to have an old-style policy, even if it's coming from your company. Okay, so if you, my company doesn't have that, so I'm just going to let my family fail. No, sir. That is a failure to provide. I'm sorry. I get a little bit passionate about this subject, but that is a failure to provide because of pig-headedness, and I've seen it, and it's disgusting. What we're looking at here is you do what you have to do. I don't care if, this is what I tell people, okay? Don't take it the wrong way. I don't care if you have to come out of your pocket to buy life insurance for your family. Oh, well, it only cost me $40 a month out of my company, and if I buy it with you, it's going to cost me $47 or $62. That's most people's argument. And it's weak, man. It's so weak. We're talking about $20, $30 a month difference. And a lot of times with the companies we use, there's no difference. People are just lazy. So what happens? They're paying $40 a month for $250,000, or I can get them $1 million for $75 out of pocket. Okay? With living benefits. Then when they get cancer, they go bankrupt. Then their wife might get a check when they die. Okay? Let me ask you this. What if that person goes bankrupt and can't work at the company anymore, so he loses his job, and now he can't get life insurance? And he dies 2 years later with no life insurance because it lapsed. You think that's possible? I guarantee you it's possible. Guarantee you it's possible. That happens. That's why I'm so passionate about people opening their minds and receiving this information. I don't care who you use. If you have a brother that sells life insurance, God bless you. Ask him about living benefits. Do I want you to use BeneShield Financial? Sure. Of course I do. However, I am an evangelist for living benefits because I do care about what happens to you and your family. And that's the bottom line. I do care what happens to you and your family, and I do want you to be taken care of. I want your wife and your kids to be taken care of. If you're a single mother, I want your kids to be taken care of. Whoever your dependents are, male, female, whatever, I want them to be taken care of. It's so sad in my line of work when I hear about people dying with no life insurance or no living benefits. They get sick. And even when I've told them about living benefits in the past, and they see people getting sick around them and they still don't act, it tears me apart. Okay? It's something that I deal with on a regular basis, you know, but it truly pains me. But I know in my heart that I've done everything I could do. For a while, I let it bother me. I don't let it bother me anymore because I'm making videos. I put the information out there. Everybody sees it. And what's funny to me, let's take Facebook, for example, is that I see a real estate agent posting a $700,000 house on Facebook, and 50 people share it and say, oh yeah, what a beautiful home. You know, now the real estate market's going down, and we've already been through that debacle. But if I tell people on Facebook, if I say, hey guys, look, check this out. You can get $1 million in coverage that'll pay you $700,000 if you get sick for $75 a month. How many people think that they're going to get sick before they die? Raise your hand. I can't see you. But the bottom line is, most of the time, you're going to get sick before you die, right? Yes. Who knows somebody that got cancer and died years later? Yes. Crickets, y'all. Crickets. And it goes to show the state of mind with the head in the sand that 99% of people walk around with. Do not allow yourself to be that person. Do not be the statistic and leave your family as a stat and with a failure to provide. You don't want that as an epitaph. Okay? And I'm not trying to guilt anybody. Okay? I'm trying to help you to understand that this takes place. This happens. This is real. So, before now, perhaps you thought that the only people with families need life insurance. Well, that's not true. Now, with living benefits, anyone who ever wants to retire, family or no family, should have and own this type of policy to protect your retirement. If you don't have family, you still need this. This opens up an entirely new world for you. And they're usually part of the index policies we discussed earlier in the last video and in the previous chapter. With proper structuring, these policies can even be used to fund your retirement. All right, so let's look at income after living benefits. Income after living benefits. Some people are opting to get insured as much as possible with multiple policies to ensure that if they get sick, they will have enough money in lump sum checks to put into income generating vehicles like annuities to fund their retirements. Therefore, if a person dies and he wants $100,000 per year in retirement, he would make sure to have at least $2 million in living benefits claim payments left over after he's paid off his home and other expenses, assuming an annuitization rate of 5%. That means you're going to get 5% of $2 million every single year from an insurance company, it's going to pay you $100,000 a year. Okay. If he wants to take home $100,000 after taxes, he'll need $150,000 in income and a $3 million lump sum to be placed into what we call an immediate annuity. There are dozens of ways to structure income after your living benefits policies pay out. Also, just because you can't go back to your old job doesn't mean you can't start investing in guaranteed instruments from home on your computer, like real estate, tax liens, etc. And we have some other things with cryptocurrency as well that we can introduce you to. That we do that are working out very, very well. This lump sum cash could be the start of something else completely new in your life, if you choose it to be that way. Now, over 50% of the people that file claims for onset critical illness are between the ages of 50 and 60. So half of the people, it's actually like 51, 52%. Half the people are between the ages of 50 and 60. Since 70% of them won't die, remember, because they're not 65 yet, 70% of them won't die due to this illness. There's still a lot of life to live, 25 to 40 years. Okay? So are you going to spend that time wishing you had gotten living benefits when you had the chance? I don't think so. We're not going to do that because we're smarter than that now. Finally, if you're a financial advisor or an insurance advisor who is caring enough about your clients to sell them life insurance with proper living benefits, then speak to your clients, realize whether or not they know what this is, and that you are the most important person in their life on that day, week, or even month. This is true. When your insurance advisor comes to talk to you, a true advisor comes to talk to you, and he introduces you to this idea of living benefits, whether you realize it or not, that man or woman is the most important person in your life at the moment. You have literally been saved from financial devastation. We're going to stop this right here on this video. And later on, like I promised, we will go through the educational appointment that's going to give you all the keys, all the selling points to get your stuff in line and to make sure you get properly educated as much as possible. Okay? Thank you so much for spending this time with me. I hope you enjoyed this information. There's lots of things you can do once you have living benefits. Money, financial, cash gives you options. And living benefits gives you those options, and they don't cost any more money. So, this is an eye-opener for most people. You are now part of the 2%. Congratulations, and God bless you. Talk to you soon. Bye-bye.